Hey everybody, welcome back. Last time we did this Q&A type segment, Greg asked anyone to give any questions they had about certain markets on where you think they're going to go or just opinions about them. And we got a lot of responses on that. This first person on Instagram asked, what are you thinking about Orlando, Florida?
Orlando, great. This is awesome, by the way. I'm really excited that people are responding to that. And just in case you're wondering, why do we care? My job is to work with big Wall Street firms to help them figure out where they should spend billions of dollars buying houses around the country, where and then how many to buy. And then we actually help them execute buying them, and then we manage them for them. So I know what I'm talking about, or at least they think I do. So let me share the screen here because it'll be helpful. Can you see my screen, Nate?
Yep.
All right, so I'm going to go into this is renterswarehouse.com investor marketplace. I'm just going to go and pull up Orlando so that I've got the visual aid here. So first of all, Orlando's in Florida, so that's a win already. All right, like we try to look at layering in multiple positives. I like to refer to as multiple ways that the market's going to be lifted. But think of it as, okay, number one, it's Florida. Florida is sucking population from the Northeast. It has been for decades. I believe it's got higher population than New York. If not, it's got more electoral votes than New York. I'm aware of that. So that's already a plus, right? Number two is that for years and years, the coast of Florida, the idea was, well, why would you go to Florida and not go to the ocean? Because of all the coastline. But Orlando was the anomaly right in the middle of the state. It was the only major metro that wasn't on the coast. And it's a major southern city, right? Orlando is much more relatable to like Atlanta or Charlotte than it is to Boca Raton or Naples. Those are snowbird communities, vacation communities, but like Tampa, Orlando, Jacksonville are major southern cities. And Orlando, you know, the anchor of Orlando, of course, was Disney World, but then it's just become a mecca for business in the South. And of course, Florida, no state income tax, very, very big deal. Okay. The migration out of New York was already happening for decades. Now, because of COVID, it's being accelerated, like downright hyperspeed. So people that were planning on going to Florida are going now instead of waiting 5 years or 10 years. And Orlando's economy is so robust and strong. I think it's great. Now, one of the little inside tips that I would have is that it's not as cheap as it used to be. Orlando and Tampa are both markets now that are not as inexpensive as they used to be. And so the whole cost of living being low isn't quite as advantageous as it used to be. And so we get asked that a lot by the big Wall Street firms who are like, well, where should we go in Florida? And we say, well, those are great cities, but they want to get a higher return. So what's going to happen next? Like what parts of Florida are coming alive now as big investment markets where they still have the benefit of the low cost of living? They haven't quite popped yet. Look at Orlando and Tampa, okay? The 75-mile radius around any metro area is kind of the extent of the metro area. So you can, if you looked at a circle around Orlando, that would kind of like come across where my cursor is, right? Same thing with Tampa. Well, they touch in Lakeland, right? I always love the highways. The highways are the things when you see a loop going around a city and you see intersection of major roads, you know something's going on because if you zoomed out, you can see that exactly exists in Orlando. It exists in Tampa, or the dots show up, but you get the idea, right? I love Lakeland, Winter Haven, all this whole area between because it's like there's two solar systems, Orlando and Tampa, and they touch right in these towns. And so you can live here and commute to Tampa, or you can live here and commute to Orlando. And especially now, well, you can live here and commute to New York now, right? With all the people that are working remote. But for a lot of people, it looks like the working remote is going to start to give way to um, commuting a couple days a week, right? So we kind of want you to, like right now, I go to the office twice a week because Andrew gets lonely, right? So, um, but so anyway. Point is that Orlando is awesome. It's so awesome that it actually represents being its own solar system, and now places that touch it are beginning to get attracted because it's such an anchor. I'm going to just zoom in a little bit and show everybody that, you know, these little dots are all properties for sale. You can see these houses on Zillow, but if you see them on Zillow, you're not going to see them with the investment analytics that we put on them. So here's the house, you know, typical little Florida house. But here's what I wanted to show you. Number one is that you get financial analytics. So our system will put a rental estimate on this property. May not be right, but it's the robot talking, so it's not always right. It's often off by a little bit, but it's kind of like a Zestimate for the rent, right? Here's what we think the house would rent for. Here's what the taxes are. So you can see that this is a 5% net yield house. That is what Florida bears right now, 5.25, right? So this is an accurate assessment. You can change any of the things that you want. Well, what happens if in a, I get 1450 because there's so many Yankees coming down to Florida right now? I make a jump to 5.69% net yield. But check this out. As I scroll down, the future performance of that investment is what these charts show you. So the cash flow on year one, I write a check for 215 grand, and I'm going to get $12,000 in profit out of that property. If I have no mortgage, I'm not putting anything else more complicated. I write a check for 215. I'm going to get almost 6% return, which is $6,000. I'm sorry, $12,000 on 200 grand, roughly. So that's my year one cash flow. But rents go up and expenses go up. So we assume that the rents are going to go up 2% a year and the expenses go up 1%, but they've been going up more than 2%. But just at 2%, I can see my cash flow year by year gets higher. So I'm already at 13 grand by year 4. And I'm already at 14 grand by year 7, right? And if I'm buying this because I want to retire in 20 years, I'm going to be at 19 grand in 20 years. But what if, so let's tag that number, 20 years, 19. But what if I get 2.5% annual increase in my rents? 21.2. What if I get 3.5% increase in my rents? $26,000. That's annual income on one house, right? I mean, if you're asking yourself, I want to have $100,000 of annual income by the time I retire in 20 years, the answer is buy 4 of these and pay them off, right? Because you get $26,000 times 4, you're there. So now that's just part of the picture, right? What the house cash flows, but what it's worth based upon the appreciation is the other half of how you get a return on investment. So in year one, I paid $215 for this house, but this market's going to appreciate by 4.89% a year, according to our index, which I'll explain in a minute. It's a pretty reliable index. That means the house is worth $225 1 year later. 5 years later, it's worth $260. In year 10, it's worth $330. And if I go to my retirement year of 20, in year 20, it's worth $530.
Wow.
So what I just said, like, imagine if your financial plan was, I want to have 100 grand in income 20 years from now, passively. And I said, you buy 4 of these little houses in Florida, right? And pay them off over 20 years, which is not that hard. You get a 30-year mortgage and you pound on it a little bit to get it done a little sooner. I buy 4 houses. 20 years later, I've got $100,000 in income, but 20 years later, if they're paid off, I've got more than $2 million in equity. I can retire comfortably based on buying 4 houses and paying them off, right? It's a great plan. Now back to this index, right? So how do I know it's going to be appreciating at 4.89%? Well, you don't, but here's what we use as our guide. I go to my market data tab. What I've got here is a long-term price appreciation chart, which feeds our index. The green line shows that 20 years ago, actually more than that now, this is going further back. We started in March of 1996. The average house price in Orange County, Florida that sold was $86,000. It peaked at $269, came back down again to a low of $111, and then rocked back out again. And now we're up there peaking again in the, close to the peak from back in the housing bubble, right? This was a bubble. This is the market fighting its way back. And I do not believe until COVID that we had a bubble situation. Again, you watch this green line, the trend line is established, but then the market deviated from the trend line. But my cursor is the trend line. Look at where it winds up hitting. If you follow the trend line, it winds up hitting right in the middle of the peak and the trough of the boom and the bust. That's not by accident, okay? A piece of property undulates like a wave, right? So if it goes above sea level, it comes back down below sea level, it fights its way back. So if I take this line, this trend line that was established in the first, 9 years, cut across the middle of the peak and trough and carry that out, it ends up right where we are. So I don't believe this is a bubble we're in now, with the exception of the prices going mad in the last couple of months because of COVID, because I'm looking at this chart. This chart shows that in the last 20 years, the average home price in this county has gone up 4.89%. That's our index. It's not adjusted for inflation. It's not adjusted for seasonality. It's not intentionally complicated. It's been damned accurate over the years because this is wartime, peacetime, high rates, low rates, good economy, bad economy, Democrats, Republicans, cats and dogs living together. All of this on one chart shows 4.89. And I go back to my financials and I see what that means is that I got $500,000 in 20 years. If that last 20-year trend continues for the next 20 years, ups and downs all included, I turn 200K into 500K. Right? That's why I like Orlando, because the population growth is unmistakable. And here's the population change. Look at that. Here's the state of Florida population change, looking good. Here's the county of Orange. Started out not as popular in the 90s and now more popular than the rest of the state of Florida. Mm-hmm. Why? Because it's not snowbirds. It's people saying, I want to go live somewhere where I can have a nice house for $250,000. I can have a good job and get paid well, and I can have nice climate all year round and no state income tax.